and welcome back to IG's Trading the Market podcast. Today, we are going to be talking about the airline and travel industry because it's an industry that's been impacted by COVID, as we all know, because of the global standstill that we saw in passenger and product movement in the global economy. Now, joining me today is Frank Holmes, CEO and Chief Investment Officer at US Global Investors. Hello, Frank, and welcome to IG's podcast.
Great to be with you.
Let's kick it off first with a little bit of a background story into the ETF that we're going to talk about today, because your company, you've had this ETF around now. It's the US Global Jets ETF, right? And it's exposed to the global airline industry, which includes airline operators, manufacturers, and it has exposure to all over the world, but it's mostly centered in the US. Now, am I right in saying that the ETF itself has been around for roughly 7 years now, but only recently launched on the London Stock Exchange last year?
Correct. And I think that what's interesting is that if you look at charts and visuals, there was a big positive bounce yet last year, except for Africa and Latin America. But we did see a bounce coming out of Europe and America and Asia, and then Asia sold off. So what's interesting about global travel is that we're still off a big percentage-wise from 2019, and that really just gives you a huge upside. Like yesterday in Jets New York, we saw $100 million come into it. And I think with all the restrictions coming off in Europe and Asia now, and the IATA, the International Air Travel Association, is calling for the removal of all travel barriers for the fully vaccinated with a WHO-approved vaccine and quarantine-free travel for the non-vaccinated with a negative pre-departure antigen test result, removing the blanket travel ban so that people can stay warm, and easing travel restrictions, recognizing that travelers pose no greater COVID risk than already exists in the general population. So I think that when you get organizations like this coming out and being very strong and saying we've gone from a pandemic to an endemic, so let's accelerate the easing of travel restrictions, and the UK being the first to drop everything in Europe, I think it poses this industry a huge upside over the next 12 months.
Great. Let's wind back before we get into COVID and more the growth prospects that you might be seeing at the moment. Let's go back to when you launched this fund. I believe that was 2015. What was the gap you were seeing there in the market? What was the push behind wanting to create this ETF? What was your selling point at the time?
Well, I have a company called US Global Investors, and we have global funds that are in Asia, and because they're in resources, they're in Africa, Latin America. I launched the first Eastern European fund in America. So I'm traveling all around the world, and I noticed back in 2013 that all these mega mergers were restricting the number of options I had to fly, and the cost of my tickets had tripled. So with that, I said I had to get the ETF business. I launched, there was no global airline ETF. And when you look at demographics and studies and research, you find that there's a high correlation to rising GDP per capita, is to rising airline travel. You're noticing some other really strong demographic movement and trend. And there was nothing there. So we went and created an index and said, this will be quant driven, and its bogey is to beat the New York Stock Exchange Global Airline Index. And we launched Jets ETF. It had a spectacular growth in assets during COVID, totally contrary to what most people would expect during the lockdown. The assets did fall, but then billions of dollars came into it, and it surged 100%. It corrected, and it appears now that we're going into the second big leg.
So looking obviously as COVID, as you were saying, a lot of people not being able to travel mostly around the world, also goods and services completely to a standstill. And as you were talking there, that potentially, yes, you had a fall in assets, but the rebound that you've seen post COVID or towards the end of the tail of COVID, if you may, because we don't exactly know when it's going to end 100%. What is the growth prospects that you are looking for the industry and in particular, but also for the ETF in terms of an investor? What is the potential that it has in the next few months, seeing that we're now coming towards the end of potentially the last of it of the pandemic?
Well, what's really interesting when we're launching and doing the research, that all these, in particular the US, were back in 2013 coming out of receivership because of the crisis in 2009. They all fall during a global crisis 70 to 80%. And then a year later, they're up 100 to 120%. After SARS, after this recent COVID 2000, in 9/11, we go back to 2008, 9. So there is a big global cyclical pattern because what we found was that it employs directly and indirectly about 9% of the economy. So that's very, very important to get air traveling, people flying again. And so one of the things that I think that for investors to look at that last year was the bottom took place as the vaccines rolled out. And we saw the launching in America and Europe, but in particular the US, brand new airlines for travel, for tourist travel, inexpensive, cheap flights like EasyJet, uh, and and that sort of growth of new IPOs. And now this past week, we're seeing M&A work in that category. So I think there's huge pent up demand in Europe to go south to get out of the cold weather, just the same as Canadians to fly south to Florida or New York, Seattle to go south to Southern California. We're going to see a big turn. But what we did see back in 2013 was the growth of ancillary fees. These are nuisance fees that we don't like, and they're like fleas and fees go together if you like the rhyme, because no one likes those change ticket fees. No one likes this, but this is huge ancillary fees, especially credit card business. So what we did see is that this business grew from about 20 billion, this ancillary fee, to 100 billion just before the COVID crisis hit. Then it shrunk right back down to 30 billion, and now it's back climbing over 50 billion. So I think that these ancillary fees are also going to be a big boom to air travel, which we'll see probably being implemented over the next 18 months. And we're also seeing a big push for business travel, and business travel is the highest profit margin for the airlines industry.
Talking also about how the industry really dropped when we saw the COVID-19 pandemic. It's an industry that's very elastic to prices and also to demand. How would you say the industry reacts to oil prices and definitely like fuel surcharges for consumers? That's potentially one of the way to pass it down to consumers, especially now that we're seeing in the market oil prices really rising to those highs that we haven't seen in the last 7 or 8 years. How is the industry expected to react to that?
I think that the industry is very sophisticated, and there's a couple of airlines that do not hedge their oil, but the other ones do. And the most profitable, consistently in the U.S. and in the world, is Southwest Airlines, and they have one of the most sophisticated hedging programs. Delta bought their own refinery, so we are seeing that American Airlines has more volatility. So what you do see is that the airline itself, if it's unhedged, its stock price will decline more rapidly with rising oil prices. But what's more important right now is this data point that started coming out right at the bottom of COVID. And if you go take a look at the data points in March of 2020, the TSA in America started publishing how many people they cleared a day. And they went from 2.7 million people a day down to 89,000 on April the 15th of 2020. And then it started to climb. But that data is published every day. And what we've seen are quant funds use that. And when it's above its 50-day moving average, we see money flows coming into the JETS ETF. And so I think that that's a really fascinating data point because we are over 2 million people flying a day in America. America used to process 2.7 million. That other 700,000 was inbound coming from Europe, particularly the UK, and coming from Latin America and Asia. And now it looks like Asia's turned the corner. There's a push in Australia to drop the restrictions, and the same thing in Europe and Latin America. So I think the inbound travel coming into America will take off in this next 6 months.
So let's talk now specifically about the stock market and what's important to investors. Because we have these expectations of future growth, and you said that we've already started to see that in the market. Has this not already been discounted into the price? Is there not potentially limited growth in terms of stock prices for these airline industry companies because we've already discounted this in the future that we are expecting it to be back to normal in the next 6, 12 months?
That's a great question, but let me start off with jets in U.S. dollar terms. New York Stock Exchange was in the low 30s before the crisis, and it fell down to the $12 range, and then it rallied up to the 20s, and then fell back to 19. So I think where you could say that if the Jets was trading over $33, $34 range. So I think from where it is now, it has another 40 to 60% upside potential over the next 12 months.
Right. And just to finish it off quickly, what would you say to an investor that is potentially a little bit concerned that the fund is too US focused? I mean, that's the name of the fund we know, and roughly around 75% of the fund is invested in US companies. Is that where you're seeing the most growth potential? Is that what should be pushing an investor towards this fund, considering the way it's invested in the US economy?
Well, if you look at the US, they had the least restrictions domestically throughout this whole crisis. I'm based in Texas, and my little girl never skipped a day in school. So I think that America has still the highest GDP per capita. It has huge GDP growth. There's $1 trillion going to infrastructure spending. And I think that that's a big reason for why the is concentrated on where the strongest growth is for the airlines and where there's liquidity. So the liquidity in the U.S. is much greater than, say, China, and China is had the much more severe lockdowns. So I would say that it's the most robust capital markets, and it has the biggest GDP in the world. So I think from that end, the U.S. that's the reason why it was structured that way. But what it does have is it has many of the airlines from Europe. It has airports. The Gaulle Airport is public. Istanbul is public. In Cancun is public. There are many airlines which are airports themselves are listed on the New York Stock Exchange. And when you go to Asia, Bangkok is public, Beijing is public. It's just the U.S. airports are basically controlled by the local communities, and it's a big competitive profit center for driving business. And so I think that it's a unique structure, but it's quant driven and will readapt and reposition as time goes along. What's necessary because it's a very dynamic quant approach.
Well, thank you very much, Frank, for joining us on IG's Trading the Markets podcast. That was Frank Holmes, CEO and Chief Investment Officer of US Global Investors. You can find US Global Jets ETF and many other ETF on IG's investments platform. For more videos from us here at IGTV, join us on Twitter at IGCom, Instagram, and subscribe to our YouTube channel.